Wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deeper seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. Time is running out. What if my best days are over? They can't be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
Okay, good afternoon. Welcome to another in our series of live revision sessions for economics. Today we're going to focus on development economics. Got a whole series, a whole bunch of nice short answer questions for you to have a go at. And as always, if you're subscribed to the channel, then you can contribute live to the chat window. You get some amazing answers. It's always worth keeping an eye on that chat window, see the quality and depth and the knowledge and the application that students bring to these sessions. Before we get going, a quick reminder that we're hitting the road in a couple of weeks' time. We're going on our Grade Booster tour. We're heading to Newcastle, Leeds, Manchester. It's the northern leg of the tour. Then Bristol and Birmingham, and then a 2-week run in London, View Stratford and View London Westfield in White City. Absolutely amazing venues. And we love being there. We're packed out, several venues already. Tickets selling really quickly. We love meeting students and teachers and having another intensive day of revision as the exams come into focus. So today, half an hour on development economics. Thank you for joining in. If you're watching on replay, just press the pause button anytime if you want to take some notes or go to a particular question. I've got 5 charts for you. And we did this on Tuesday, and I think we got 4 out of 5. So can you identify this macro chart? There's the countries for you. It's in billions of dollars. Who is the first person who's going to correctly identify what this chart is showing? All of these charts have a development focus. So we'll keep an eye on the chat window and see who can get the right answers coming through. What do we think? India, way out ahead. Mexico, the Philippines, France, and then China. So JT Galaxy, one of our great regular contributors, has gone for gross national income. It's pretty close. It's not the correct answer. What do we think? George Whelan said government spending on infrastructure. It could be. India's certainly a big enough country with an infrastructure demand, but it's not that. Okay. Wow, I think I've already beaten the group. It's not infrastructure spending. It's not GNI. It's one of the most important developments in the world of development. Anna says gross national happiness. Joe Preston. Congratulations to Joe. Joe's got the right answer. Let's reveal the answer. Well done, Joe. It is highest remittance receiving countries. Now, again, feel free to take notes as we go through. By the way, we're going to create a blog at the end of the session, and we'll have this PowerPoint as a download, as well as in the comments section. You can download the PowerPoint later on. But key context point: remittances are now the biggest single inflow of external finance money coming into a country for lower middle income nations. So remittances are now bigger than aid, bigger than FDI, bigger than private external debt. It is hugely important that you understand what's driving remittance flows around the world, the causes of that, and the consequences. Super important. Okay, so well done, Joe. All of these charts and things, all of the stuff we do today, Mia, are application for 2025 papers. Okay, second chart, number 2. Again, I've taken the headings off, but this is percentage. To give you a clue, Sudan comes top, followed by Japan, Lebanon, Singapore, Greece, and Argentina. What do we think? Percentage. And I think Joe was pretty quick, but I think Dan B, who was superb on Tuesday, Dan's coming with the right answer. We'll showcase some great answers today. It is indeed the ratio of government debt to GDP. In fact, everybody says the answer is always Japan. Sudan last year had the highest debt to GDP, 2.5 times the national income. But context point here, it's not just the scale of government debt that matters, but also the yield or the interest rate the government was to pay when issuing bonds. So, for example, Japan has a huge national debt, but the yield on their bonds is less than 1%. Whereas the UK has a debt of 100% of GDP. Doesn't quite fit onto this chart, but the yield on debt is 4.5%, 5%. It costs them a lot of money to pay that debt, the debt interest. So well done to Dan B. Here's chart 3. By the way, if you get all 5, that is impressive as a group. Can you identify this chart? Well, just the numbers: 15.1, 16.1, Niger, Uganda, Mali, Chad, Democratic Republic of the Congo. What do we think? And again, this is a really key development chart, particularly if you're an economist and a geographer, to give a little bit of a clue. What do we think? George says it's the birth rate. Live births per female? George, no, not quite, but you're in the right ballpark. So well done, George. Sam says, is it inequality? It isn't. So Louis and Sam both said inequality. What do we think here? It's not. And Maisie comes up with a great answer, says number of people per doctor. Joe says mortality rate. We're pretty close, but it's not mortality. I'll just give it another 15 seconds. James Lund thinks it's the adult literacy rate. A bit low, James. Anna says HDI scores. Well, it's linked to HDI. William says age. Now, Will, you are the closest so far. Jazz says mean years of school. Louis says fertility rate. Will says the average age. It's not the average age. So instead of the mean, who can get it first? It's not the average age of population. What do we think? It is the median. Well done to Maya. Got that right? Yeah, these are the countries in Africa with the lowest median age. Actually, funnily enough, it's the countries in the world as well, actually, with the lowest median age, pretty much. My context point is that rapid population growth from having a very young population can be a driver of growth, but also a significant barrier to development. If you're an EdXL student, please do revise the demography of development, causes and consequences of rapid population growth, and policies to address that. Right, okay, 2 more. More people joining us. If you're just joining us, we're going through some charts trying to identify them. Okay, so again, some countries here. The world figure is 9%. DRC, highest. Madagascar, Malawi, South Sudan. And the year, in brackets there, is the latest data. Okay, it's the year for which the latest data has been published. Maisie has come in straight away with the right answer. Fantastic. Well done to you. percentage of population in poverty. Let's be a little bit more specific. Here's the answer. It's the countries with the highest share of the population living on less than $2.15 a day PPP. Now, keep in mind, of course, that the poverty line has now changed. You need to know this for the exam. A lot of teachers still say it's $1.50 a day or something, $1.25. No, it isn't. It's $2.15 a day for low-income countries and $6.85 a day PPP for developing countries. So the World Bank now has two PPP-adjusted extreme poverty lines. Brilliant stuff. Right, one more. So well done to Maisie on that one. Oh, by the way, before we do that, here's a chart showing the balance between high and low and upper middle and low middle income countries. You can see the progress in the last 30 years in reducing extreme poverty, but very few. I mean, look at the green there and the kind of purpley mauvey areas. Very few countries have actually graduated from middle income to high income countries. Greece was one, South Korea was another. This is called the middle income trap. A lot of countries get to an upper middle income level and then find it hard to get to the next level. Bit of context there. Okay, last one. Can you identify, please, this macro chart? And this time, South Africa, Namibia, Colombia, and Eswatini come as the top four countries. What do we think? It's not HDI. But Will, I think Will has come in. Yeah, Will Dang has come in with the right answer. Joe and Anna, sorry. All good. Here he comes. That is the highest Gini coefficients in the world. Okay. South Africa is way out ahead. Namibia, the two countries obviously adjacent to each other. Now, the key point to note here, if you get Gini coefficient data, always data. National income statistics are notoriously unreliable and inaccurate in many different countries. The size of the informal sector can vary widely, and therefore measured income might be out of kilter with actual income, and the Gini coefficient is taken from measured national income. Hey, well done, everybody. Fantastic start. Well done. Okay, so we're going to choose a few topics in development, and we're looking for some brilliant answers from the group. The World Bank has just done some research. They think that a 1% increase in growth in the three biggest countries, developing countries, China, India, and Brazil, through the BRICS, that can lift GDP in other developing countries by nearly 2% after 3 years. There's quite a strong, sometimes called a growth multiplier, but if China and India grow more quickly, other countries get a multiplier effect, which is quite a nice idea to bring into your answers. Over to you, a minute on the clock. Can you give me 2 reasons why faster growth in countries such as India might increase GDP in other developing nations? Have a go. So keep it on the chat window, and we'll post some of the best answers on the screen. Well done, everybody. Great start to the session from Shamita, from Louis, from Phoebe, from Maisie. Some great answers coming through. We try to pick out, our production team are pretty good at picking out some great answers. And the key here is the link between faster growth in India, for example. How might that have a spillover effect? Use a micro term there, to growth in other countries. As we're talking about interdependence between countries. I love that phrase. Wow. Increased Indian exports allows other countries to use raw materials to produce more, boosting GDP. Excellent. Yeah, lots of you talking about trade and specialization and the potential gains from trade. The key here is to link growth in India to growth in other countries. Now, trade is a connecting point, isn't it? India has large tech and telecoms industry, can produce these goods very cheaply. This can be implemented into developing countries, accelerating their development. Great stuff. Here's my 2 points. I mean, there are many, many points you can make. The link, I think one is the growth import link. So India is clearly a major consumer of metals, oil, gas, agricultural products. So if India grows more quickly, that increases the global demand for these commodities, hopefully increasing prices and shifting the terms of trade and the balance of trade towards commodity exporting developing countries in sub-Saharan Africa, for example. And the point about remittances, we started our session today. Many developing countries have a very large labour force working in India, and a growing Indian economy increases remittances sent back to the country of origin, stimulating activity. So I went for import demand from India and remittances as my 2 points. Let's evaluate. So why might many low-income countries not necessarily benefit from faster growth in India? Again, 1 minute on the clock. Have a go. Yeah, thank you. And thanks to George there for that point about externalities. If Indian taxes rise, companies may move production to neighbouring countries. Issues of pollution and worker exploitation. We'll come back to that, George, actually a bit later on in our session. This is a hard question, by the way. Look, in theory, other countries should benefit from faster growth in India, but it isn't always the case. Here's ACE's point. Faster growth in India may take attention away from lower income countries and may slow down their development, especially if they rely on FDI. That's a really subtle point. There could be some sort of crowding out idea here that if India becomes a more attractive venue for FDI, that might cause a displacement. Yeah, some good points here. Phoebe talks about the brain drain effect. People have higher incomes, they may seek employment opportunities abroad from developed countries. So that might lead to a brain drain of the most productive workers, impeding growth, linking back there to growth. Here are my 2 points. I've gone for the argument that these countries may have supply side limits. So many low-income countries lack the critical infrastructure, they lack the skilled labour or the technology to really scale up production. So India is demanding more from other countries. Yet do these countries have the productive potential to supply those goods and services? And these countries typically export a narrow range of goods and services anyway. By the way, I've put in put in green the word critical. It's just sometimes adding the extra word in critical infrastructure, ports, technology, bandwidth, whatever it is, rail connections, that kind of stuff, the really important infrastructure. And the other one I want to link to is monopsony. So as India's economy grows, we know that there's lots of huge Indian kind of multinationals, Reliance Industries, for example, Tata. Those firms are huge in a global context. Those corporations are large. And so they may develop monopsony power. I hope you've covered monopsony. And so in theory, if those Indian companies operating at scale, if they have monopsony power, they can dictate the prices paid for raw materials from Angola or agricultural products from Kenya, who knows? And that can drive down profit for suppliers in those smaller, weaker economies. 2 answers there really about the supply side. Can low-income countries increase production? And also the balance of power between countries. The BRICS nations are powerful forces in the world economy. Anne says, wouldn't talking about monopsonies be micro? Yes, and hence it could be a really good synoptic question. But don't be afraid, monopsony power at a macro level does matter. If you have got a company or a transnational corporation which is a huge buyer of something, macroeconomics has micro foundations. So don't be too worried about bringing a micro concept, as I have done. So moving on. Let's move on to another key topic. Bit of background. I've chosen Ghana for you, the world's third largest exporter of raw cashew nuts. About 200,000 tons annually, with 80% exported in unshelled form, basically the raw nuts. Whilst the industry generates 300 million in export revenues, but Ghana loses out on significant value-added profits since raw cashews are processed abroad, often in India, Vietnam and Thailand, and then re-imported into Ghana at high prices. So farmers can earn around $50 per 100 kg of unshelled cashews. Retailers can sell the processed cashews for, well, thousands of dollars per ton. So there's the backstory. And of course, what's this about? This is about primary product dependency. Let's spend a minute or two revising this as a group. Can you give me 2 consequences of primary product dependency for a country such as Ghana? Over to you. Okay, superb. Wow, loads of good answers. This is clearly a topic that students have covered. And your ability, by the way, to apply the ideas to the Ghanaian context is super impressive. Some loads of great points coming in there. I picked out one from Louis and one from Will. They're absolutely superb. What have we got here? Uncertainty such as bad weather can affect supply of cashews and negatively affect GDP. Correct. By the way, many of these countries are exposed, particularly exposed to the effects of climate change, erratic rainfall, uncertain temperatures, and they don't necessarily have the infrastructure to be able to store products efficiently and at cost. Loads of you talking about James Lund, for example, low-value industries and particularly exposed to price fluctuations. Louis made the same point about low-value goods, and quite a few of you bringing in income inelasticity. I think I saw one reference, implicit reference to the Prebisch-Singer hypothesis, which is part of the Edexcel point. Yeah, some great stuff, some really good answers. I've gone for volatility and instability. I've linked the two together. So primary commodities often exposed to big global price volatility. A big price drop obviously damages farmers, but also damages government tax revenues. And that can lead to economic instability. So you tend to find that the farming industry or the primary sector is more volatile than the GDP, but the two are linked. And I've gone for the environmental aspect. I know many of you really are very keen on this idea that if you try and scale your industries, so cashew production in Ghana, large-scale industrial farming and resource extraction can often lead to deforestation, degradation of the soil, water pollution. And of course, over time, those externalities bring down productivity, reduce export potential. The maximum sustainable yield goes down, and that can increase food insecurity. Either way, in an essay, just choose 2 key consequences. And one of them, in theory, should be more short-term, and one of them should be more long-term. That really helps to develop your analysis. Fantastic stuff. Noah talks about income elasticity for global incomes and things. Some really good stuff. So thank you for that. Okay, let's evaluate. Can you give me 2 policies that might help to bring down PPD for a country such as Ghana? Really interested to see what you can come up with. Let's start the clock. So again, some sophisticated answers. The more specific we can be, by the way, the better. So as we talked about on Tuesday when we talked about supply side policies, generic points are fine, and they're fine, they're good, but actually they're more specific. So Maisie, for example, talks about management strategies such as currency hedging to mitigate global fluctuations. Yeah, I think the point I would make there, Maisie, is that in many of these countries, I don't know how strong the Ghanaian central bank is against the combined forces of global speculators. Often central banks are essentially price takers in currency markets. But many of you, Janvi Joshi talks about investment in local processing and value addition, and also talks about export restrictions and tariff adjustments. Now that is, you're hinting something there at a really, really important point, really great point there. I've gone for the following. I've gone for agro-processing and manufacturing. So yeah, the key really is something I'd like to give you a term for. It's called vertical diversification. So the government, the Ghanaian government, might offer some tax incentives, some subsidies, maybe some financial incentives, low interest rate loans to local businesses that might be able to invest in processing industries. So instead of just extracting and growing, process, such as cashew roasting and chocolate production. That's the application. Now that might come from local investment, it might come from FDI. But the key really is to achieve what's called vertical diversification. It's a great point to add to your notes. Feel free to do that. Because at each stage of the value chain, the profit margin tends to go up, especially when you get to retail level. And simply moving from growing and harvesting to processing and retailing and refining, you get the extra profit margin. So this is called agro-processing, essentially. And I think export incentives. So try and grow your processing industries and then perhaps subsidize processed products to encourage local manufacture. So export subsidy, for example, would make Ghanaian roasted cashews more competitive in the African market and globally. But again, think long term here. The more specific you can be, the better. A couple of people talking about price fixing, hinting at buffer stock schemes, which is certainly on the EdXL syllabus. Not sure if it's on the other ones. Brilliant stuff. Right, let's move on. We're doing really well. Yeah, this is really key here. So I just want to give you a feel and a flavor for what's happening in the world economy. Follow the red dotted line. That is remittances. Okay, I said a few minutes ago, it's hugely important now. Remittances, a couple of years ago, overtook FDI as the biggest single source of money, finance, coming into emerging low-income, middle-income countries. FDI has fallen in the last 2 or 3 years, particularly since the pandemic. Aid, can you just see that? I haven't got the latest data, but aid is now coming in third. Loans and debt and that kind of stuff comes in fourth. So remittances now outstrip FDI, but FDI is still important. Bearing that in mind, let's move on. And again, I wanted to try and be clear here. Let's think about FDI. So think about low and middle income countries. Can you give me 2 demand or supply side benefits, or maybe one of each, of inward investment for these countries? Have a go. Okay, the answers coming through. I'm keeping a nice close eye on the chat window. Oftentimes we have some great answers coming through as we're going through the answer. Like that answer there from Janvi. FDI brings advanced technologies, knowledge, yes, know-how, and expertise to host countries, improving productivity and efficiency in local industries. Yeah, improving labour productivity in particular. Dan B asks us to think about sharing of knowledge, driving process innovation that can increase productivity and efficiencies, lowering the unit cost of production, and that has supply side benefits. Yeah, Dan's suggesting here that really if you can increase productivity and efficiency, you can shift out both short run and long run aggregate supply, so the supply side benefits. Elliot, one of our great contributors, talks about allows for greater investment in emerging industries, leading to less primary industry dependency. So, and also an expansion of hopefully better paid jobs. One of the most important things you can do in a developing country is increase formal employment and get businesses operating at scale. Nikita talks about high corporate tax revenue for the government and obviously more people in informal work. Really good stuff. Down improved infrastructure and quality leading to better productivity. Making some good application here with the China's Belt and Road initiative into Africa. Yeah, absolutely fantastic. So it looks like everybody's pretty well clued up here on FDI. I'm going to try and add some value. Here we go. So I've gone for income growth and productivity as my points. Typically, not always, FDI increases real. So those of you just adding one word, if we're just adding the word real. Technology transfers management knowledge from parent companies, and often labour productivity does increase. Productivity isn't the only thing in economics that drives growth, but it's pretty much the only thing. If you can lift labour productivity, you can pay people more. And if per capita incomes go up, that has multiplier effects throughout the economy. So income growth and productivity are sort of they're very close cousins. And I've gone for infrastructure and finance. So the FDI doesn't have to be manufacturing, it could be foreign banks, it could be insurance companies, increasing access to credit for local businesses, including farmers, perhaps at lower interest rates, insurance for farmers, and multinational enterprises can help fund transport, energy, logistics, which ultimately you need to export. So here's the point. FDI can be triple powered. Triple powered. What do we mean by that? It increases aggregate demand, investment. It increases aggregate supply in the short run and in the long run as well. So in theory, FDI has a triple powered effect on short-term and long-term growth. I know what you're thinking though, Jeff. Let's evaluate. Let's evaluate. Over to you now. Really pick your points here. Okay, can you pick out 2 risks, 2 drawbacks of government policies that are specifically designed to bring in FDI? Have a go. Some great answers coming through on the screen here, particularly like Joe's point, the Trojan horse effect. Okay, so these TNCs may only employ home senior managers, so they're happy to employ construction workers and assembly workers, but the higher skilled jobs often are taken up by migrant workers. Joe calls that the Trojan horse effect. Lots of answers coming in. Okay, Quinn comes in. We'll come to Will's point and then Quinn Downs' point. So Will talked about the risk of hot money, where investment and income leave the economy in times of recession. So FDI tends to be footloose. And the Asian financial crisis is a really good example. Foreign direct investment is often quite footloose. And Quinn comes in with this point. It depends on the extent. By the way, anybody who uses that phrase is going to evaluate really well. It depends on the extent to which profits and wages are repatriated. Yeah, I think you're hinting there, Quinn, at the size of the multiplier effect. Does FDI create significant income multipliers? A lot depends on, well, points we're making. What else have we got here? Okay. Oh, yeah. So Elliot Huggins, again, Elliot's been superb this afternoon. Overdependence on foreign investors, which may make the economy vulnerable to external shocks if these investors withdraw. By the way, I like the use there, Elliot, of your hedging word, which might make or may make. Not will, but may or might. That is what's called the hedging word, and it makes your evaluation even more subtle than it already is, and it's superb already. Yeah, okay. JT Galaxy, just very quickly. Oh, if we can come back to JT's point, one of our great contributors. Increased FDI does not necessarily mean high employment. It depends on the human capital of developing countries, which usually have a lower average years of schooling. There's often that gap, isn't there, between the mean and expected years of schooling in many countries. That gap is often between 5 and 10 years. So lots of you talk about overdependence and the fact that governments might be pressurized into offering incredibly incentives. I've gone for environment again, and I've gone for the spillovers. So again, really important here. So multinationals, particularly in extractive sectors, they're typically linked to deforestation, pollution, long-term depletion of natural resources, and there's something called pollution haven behavior. So maybe we've added vertical diversification to your notes today. I'm going to add Trojan horse to my notes after this session. Pollution haven behavior is where multinationals shift high emission activities to countries with a lower pollution regulations without a carbon tax, for example. And that's a really, really important evaluation point. And often we talked about importing labor into these countries, but multinationals often import most of their inputs, limiting integration with local suppliers and reducing the multiplier effects. That's particularly the case, by the way, in things like tourism, big multinational hotel chains. The extent of technology transfer is often low, as multinational enterprises keep high-value research and development and innovation at home. So it's typically the outsourcing of manufacturing and assembly rather than the R&D, the marketing, the retailing, the high intellectual property elements. But some great points. Right, one more question, and then we're done today. Absolutely fantastic, by the way. It's absolutely unbelievably good points. Last question is about trade, globalization, and development. According to the recent data from the WTO, trade between developing countries, accounts for about a quarter of world trade. It's gone up by 10% in the last 20 years. And that's called South-South trade, trade between developing countries. It's growing by about 10% a year. My question is, to what extent is international trade a benefit to growth and development in emerging countries? This is a very popular exam question. So let's finish with 2 one-minute challenges. Can you please isolate and identify 2 benefits of trade for growth and development, or one or the other, in emerging countries? Have a go. Okay, Shamita had a lovely point about some of the sort of micro benefits. The fact that everybody has an iPhone or a Samsung Galaxy these days allows low-income countries to access goods and services they would have never been able to make themselves afford. Effectively, what Shamita is talking about there is something called effective demand. So trade can bring prices down across the board for many things, and that increases effective demand, or effectively increases your real income. So $1,000 will buy you more if trade brings prices down. Quinn Downs talks about expansion of consumption possibilities. Yes. I'm not going to show a diagram here, but trade in theory shifts out the consumption possibility curve. Comparative advantage facilitates specialization, which increases global output. I could not have written that better myself. That's a really nice phrase. Comparative advantage facilitates specialization, which increases global output, assuming, of course, the assumptions of trade have to be met. Ace comes in with a lovely point about emerging economies receiving capital equipment that's been tried and tested might allow production to increase more efficiently, increasing productivity. Interesting that actually make that a really good point, but don't assume automatically that it's developing countries and emerging countries that are importing the capital. Increasingly now, the world is changing day by day, and increasingly now the investment, the R&D, the innovation is coming from emerging economies. Just think this incredible R&D spend in countries like, more recently, South Korea, but now India and China. Innovation and investment is not a one-way street. So the points I made are as follows. Here, quickly. I've gone for growth. I think one of the benefits of trade is growth. Emerging countries can capitalize on their comparative advantages, such as relatively low-cost labor, access to natural resources. And growth, of course, in theory, generates employment. Employment generates tax revenues. And I've gone for poverty reduction. So George Wheeler made the point about export-led growth in the chat window. George is right. If you take some of the poster childs, China, Vietnam, Bangladesh, other countries as well, Indonesia, Turkey, I mean, millions, hundreds of millions of people have been lifted out of extreme poverty, and trade has been part of that. Trade attracts FDI, and typically that creates more formal jobs in textiles, electronics. People become part of the waged labor force. They have a formal job. And if productivity goes up, their demand goes up, so consumption goes up. Let's finish off with this evaluation question. The answers today have been insanely good. I mean, wow, outstanding. So evaluation, over to you. The last chance to contribute today. Give me 2 drawbacks of trade for growth and development in emerging countries. Have a go. Wow, you're pretty hot on the evaluation, the risk of imported inflation there. People talking about, what have we got here? Oh yeah, reliance on trickle-down effects for equal growth across the economy. So we'll come back to that point, Will, about inequality in a second. Yeah, a lot of stuff. Talking about dumping, that developing countries can dump their products in developing markets at below cost. That, again, that can happen both ways, as we've seen with steel from China. Okay, and Janvi says this point: many African nations produce raw materials, but lack the supply side capacity to trade higher value goods among themselves, forcing them to still rely on developed countries. Yeah, some really good stuff. By the way, this is an intersection between year 12 and year 13, I guess. You're absolutely fine if you use your year 12 macro. When it comes to the top grades, we're really looking for that little extra context. Well, hopefully my 2 points might add a bit of value. So I've gone for inequality. And the truth is that the gains from trade are rarely, if ever, equal. Not all sectors or workers benefit equally. And some of you were hinting actually in the chat that lower skilled workers in some sectors might lose their jobs because of automation and import competition. And it's sometimes called the paradox of trade, that trade can lift average incomes, but actually increase inequality at the same time. So one of the paradoxes of globalization. Let me explain that again. Trade can lift the average income, but it can actually make inequality worse. So the median living standards might not change much at all. And I've gone for the, Regina talks about environmental degradation, something we'll talk about next week. I've gone for dependence on external markets and volatility. So if you're very heavily trade dependent, if you think about a country like Mexico or Vietnam or Bangladesh, you are exposed to external shocks. A recession in your major trade partner or global trade wars, where are those these days? And of course, many developing countries suffered during COVID and in the wake of COVID when supply chains around the world were disrupted. And we're now seeing nearshoring essentially taking the place of outsourcing in many sectors. So loads of great points. Addy's talks about unequal competition. Regina talks about loss of local industries. Esme says, can you please repeat the paradox point again? I would happily. Sometimes called one of the paradoxes of globalization. Okay, so trade inextricably linked to globalization. So trade, the benefits from trade can increase per capita incomes, and they have, but not for everybody. So trade can also cause the level of relative poverty as measured by the Gini coefficient to go up. And it's really up to whether governments have the wherewithal and the resources to be able to compensate the losers from those who are the winners from open trade and trade liberalization. It's a huge issue, and it's something you come across if you do economics after A-level. Well, then, everybody, let's quickly remind you that I think we're heading to, let's get this right, Newcastle, Leeds, Manchester, Bristol, Birmingham, and then a 2-week run. It's like the West End in London over the next 6 weeks or so. We really love our grade booster events. It's great to meet people face to face. Lots of individual students, by the way, book and come. You know, they tell the school they're coming, but they come anyway because they're desperately keen to get those extra grades. And the grade booster courses are superb for that. Now, next week, we're going to do a double header. I'm away on Tuesday doing some university sport. I'm away, so Thursday we're going to double up. We're going to do a session at 5 o'clock on labour markets, I think, and then 6 o'clock environmental economics. Could be the other way around, but it's a double header next week. How much fun is that going to be next Thursday night? And a great chance to put some more minutes into the revision bank. I know quite a few of you, you've been in touch saying you've got mocks next week. So good luck with those. The thing about mocks is they're just really good practice. If you get it wrong in the mock, nobody's going to bother in August because you learn your mistakes. But to help you, if there's a multiple choice question in the mock, it's either A, B, C, or D. And I hope that's helpful to you as you head into your mocks. Shamita says, how do we get tickets? Go to TutorTube and just search for live events. Or just go to Google and just type TutorTube Grade Booster and the link will come up on the screen. As always, thank you to everybody who's contributed. We've got a great group of students that's growing. More and more students are joining the Student Collective. And I think over the next 80, 90, 100 days, we are going to work so hard towards those A-levels. And we know from previous experience, by the way, this group makes a difference. Okay, the collective wisdom and the support of the group can really make a big difference to people's grades. I know that because I've been chatting to students at various universities and saying, look, you know, we actually, you know, we've been in touch with each other. We met on the Tutor2 live stream. How cool is that? Take care, everybody. Stay safe, stay happy, stay curious, and we hope to see you sometime soon.